Hello, Steve Lenz here with Discover Options. Welcome to this presentation of 3 different market timing reports for advanced options traders of the S&P 500 index options. This will be for Friday ending June 8th, getting ready for Monday, June 11th. Presented material today is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. Okay, before we get going, want to ask you to subscribe. That way you will be given, ample notice when we come out with new videos. And also we have a free ebook called Simple Steps to Options Trading Success, co-authored by myself and Jim Graham. All 3 reports tonight look at the current market condition, and we define that in 3 different dimensions: price action, trend, and the stochastic situation. In terms of price action, Friday was an inside bar that followed Thursday's upswing bar. That price action occurred while we are above the 50-day simple moving average. And in terms of the stochastics, it's trending upward, and it's kind of in the overbought area above 90, but we define it as being between 60 and 100. Okay, so that market condition in total has occurred 100 times since January of 2000, believe it or not. Okay, so with that market condition defined and understood, let's go to the first timing report. This is for butterfly and condor traders of the S&P 500 options. And so since January of 2000, as I've said, we've had actually 4,637 closes of the S&P 500 index. Of those, 64.8% have been favorable bars for selling premium, where the actual 21 bar subsequent movement was less than the SIBO skew adjusted implied movement. That is coming from the option prices themselves. So you can flip a coin, and almost 2/3 of the time you'll land on a bar that turns out to be favorable for condor and butterflies. All right, now also during that time, as I've mentioned, we've had 100 occurrences of our current market condition. Of those 100, look at this, 76% have been similarly favorable for option premium selling. So that's a higher number than the 64.8. This implies an edge then of 11.2%. That's pretty outstanding. Statistically, it's more likely than usual then that our market condition will end up being a favorable one for market neutral option premium selling. Okay, so that's the Condor butterfly timing report. Let's now go to the bull put spread timing report. This presupposes that you're going to sell put options, a standard deviation out of the money, 30 days out. Okay, so let's just go right to the numbers. Since Jan of 2000, as I've mentioned, we've had 4,637 closes. Of those 4,637, almost 83%, 82.9% have been favorable bars for selling put premium like that, where the actual 21 bar downside movement turned out to be less than what the option premium was implying to the downside. Okay, so you could flip a coin, and roughly 83% of the time you'd have a bar that was favorable for selling put option out of the money like that. But let's take a look at our current condition that occurred 100 times. Of those 100, 87% of the bars were similarly favorable for selling put premium like that. So this implies a put selling edge of roughly 4.1%. Statistically, it's more likely than usual that our current market condition will end up being a favorable one for doing this. Now, does any of this mean that you'll automatically make money? No. It just means that this current market condition presents statistically an edge should history play a part in the future. All right. Finally, let's go to the market likelihood report, where we are looking at our current market condition in terms of the rate of change every 5, 10, and 15 days. So again, we've had over 4,600 closes. Now let me go ahead and highlight this part here. All right, so there we got 4,640 closes. Of those 4,640, if you were to take one close and go 5 bars in the future, on average, since January of 2000, you'd have a gain of 0.1%. We've had a bullish market all in all since then. We've had certainly seasons where the market's gone down, little bear seasons, but all in all, the market has certainly gone up an average of every 5 days of 0.1%. Every 2 weeks or 10 days, 0.19%, or almost a fifth of a percent. Finally, every 3 weeks of 0.28, over a quarter of a percent every 3 weeks. All right, so that is the baseline rate of change. Now, if you go to the 100 the 100 occurrences of our current market condition, you have roughly the same thing. 0.11, okay, 0.22 instead of 0.19, very, very close. And then 0.19 is actually a little bit less, is a little bit less than the benchmark. Interesting. But the z-scores are all negligible here, so we're pretty much sitting right at benchmark, at benchmark levels here, all in all. Now, where the difference kicks in is if we look at the situations where Friday's bar was exceeded on Monday, all right, to the high side. Let's say that Friday's high was taken out on Monday, coming up here tomorrow. All right, that happened 61 times out of those 100. And of those 61 occurrences, the 5, 10, and 15 bar rate of change was certainly much higher than the benchmark. Okay, but by less than 1 standard deviation. These z-scores are well under 0.5. So we have a bullish move, of course, if Friday's bar gets exceeded. But on average, you have a rate of change of less than a half a standard deviation to the upside. Not a whole lot to write home about, but certainly something to take note. Now, if on Monday the market goes down below Friday's low, okay, how has that panned out in the past? That's occurred 58 times out of those 100. And of those 58, look at this, the market went down 0.13, down 0.15, and down 0.18 for, again, z-scores to the downside of less than a half a standard deviation, not even 0.50 to the downside there. So, again, the z-scores are nothing to write home about, but just something to take note that if the market goes above Friday's high, good chance it's going to continue up, but not necessarily by that huge amount of certainty. And then again, on the downside, it's likely to continue down, but again, the certainty level is not even at a half a standard deviation level. Finally, let's take note of volatility. The benchmark realized volatility of the market is between 15 and 16%. Okay, and then our current market condition averages out to roughly between, say, about 11 to 12%, far underneath the benchmark realized volatility. And then here we can see the broken out if it goes up or if it goes down. But go down here, look at the VIX was at 12.18, a value that is higher than the realized volatility for the 5 or 10 day levels there. About scratch for the 15 days. All right, so interesting stuff. Clearly, if the market goes above Friday's high, though, you have realized volatility on average far less than what the VIX is at. So hence we have the edge that we've been looking at for those other strategies. Okay, wonderful. Folks, thanks for joining us. I'm Steve Lentz with Discover Options. Have a great rest of the, have a great week trading.